Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Chris Batchelor, and we're talking Aspen Group Limited, ASX code APZ. Now, Chris, this has got nothing to do with your interest in caravanning and off-roading.
I thought you were going to ask me something about skiing. No, not at all. No, to be honest, it's just struck me because the numbers are looking really attractive, but I do admit I do have a bias towards those sorts of businesses as well.
So, in this case, tell us about Aspen and what kind of business it is.
Yeah, so Aspen's an interesting company. They're a property developer and portfolio manager, but they're quite different to what you might think of as the typical sort of property developer. What they do is they target the problem that is being talked about continually, which is the housing affordability crisis. And so they have a very large portfolio of properties that primarily they rent, and they rent them to people. Their target market is the 40% of Australians with an annual income of less than $90,000. And so they're trying to put together a portfolio of low price rentals. They aim to keep their average rentals under $400 per week. And currently, looking at the rental market across Australia, it's actually less than 6% of properties that are available for rent that are rented in that lower price band. Of course, the worst cities are Sydney and indeed Canberra. But Aspen managed to rent their properties out at an average rental rate of $317 per week. They're expecting that to increase to $390 per week in the current financial year, but nevertheless, that's still well down on the average for the market, and indeed it's below that $400 threshold.
Well, it sounds like a case of caring capitalism almost. Is that the case?
Yeah, honestly, it is. I mean, they're certainly still capitalists and they're making very good profits, and that's why they're attractive as an investment opportunity. But yeah, they do certainly emphasize the social aspect to their work, and they are providing for that need, which is, a very important and pressing need throughout the country.
A company like this, is it similar in any way to a real estate investment trust or a REIT?
Yeah, it is. I mean, the basic premise of a REIT is that they own a portfolio of properties and they rent them out. Now, typically, you're looking at commercial properties with most REITs. So, there aren't very many residential-based REITs. There are a couple of others, but this is, one of the main ones. And yeah, that's the basic premise, is that you own a portfolio of properties and you lease those out to provide a steady return for your investors. You also potentially have the gain on the valuation of those properties, which is indeed a factor for them. And in the case of Aspen and indeed many REITs, they also do some property development. So they buy land banks and they develop different forms of accommodation, and some of those get sold off and a lot of them get retained within the portfolio and rented out to prospective renters.
So we've seen a bit of a bounce in the share price of Aspen over the last week or so. Has this been a reaction to the sale of Eureka Group shares? What's the story behind that relationship?
Yeah, so that's an interesting one. They bought into Eureka some time back and held a share of around 14% of the Eureka shares. Then earlier this year, they made a takeover offer for the whole of Eureka, and it was an all-scrip offer, meaning that they were offering a portion of their shares in exchange for Eureka shares. But what they did, which was pretty curious, is it was quite a low-ball offer. It came in quite well below the prevailing share price at the time. Now, not unexpectedly, that wasn't particularly well received by the board and the shareholders of Eureka. And there were a couple of revisions. Twice they did increase the level of the offer, but even with the final increase, it was still well below the share price at the time. And the Eureka board, as they are required, put together an independent expert report, and that report came out saying that the offer was neither fair nor reasonable. So needless to say, the majority of shareholders rejected the takeover offer, Eureka shareholders, but not all of them. They still did manage to get a further 22% of the business, which took their stake up to 36%. So they owned 36% of Eureka, and they got that, I'm not sure of the exact amount, but it was sort of in the low 40 cents prices. And then they have just managed to sell that just a couple of weeks ago at the end of October. They're selling half of their stake, so about 18% of the shares in Eureka, for I think it was 61 cents. So they've made a really decent profit over literally less than 6 months. So, it's kind of a smart move, really. It's just a bit of a trade, but they've come away from it with a very decent profit. So, that's not their main business, but it's kind of just a case of seizing an opportunity and doing rather well out of it. So, yeah, the share price has naturally been quite impressed by that little strategy, little side business. And, yeah, it's interesting to see what their longer term plans are. I mean, they still have a significant stake in Eureka with 18%. They may come back and try and take it over at some point in the future, or they may just be willing to ride it. So they had said they were going to try and get on the board and push for a new CEO in Eureka, so try and make changes from the side. But now that they've reduced their stake, they'll still have some influence, but less than they would have. So it's really an open question as to what their longer term intentions are. But they have shown that they're quite happy just to manage their capital and take a profit when they see the opportunity to do so.
Presumably Eureka's in the similar sector, is that right?
Yes, a very similar business, that's correct.
Just wanted to explore for a moment. You mentioned an all-scrip offer. Can you explain to listeners what that means? And I'm assuming that it means that they didn't have to put their hands in their pocket to buy Eureka. They were just able to swap shares. Is it something like that?
More or less, yes. So there's two ways you can acquire shares in another company. You can offer cash or you can offer scrip, or a combination of the two. So this was a case of all scrip, meaning that Aspen said to Eureka shareholders, if you take up our offer, for every Eureka share that you hold, we will give you 0.26 Aspen shares. And they're not existing shares. What they're doing is they're issuing new shares when they do that. So they're increasing their capital base. It's effectively a kind of a capital raise for Aspen. And then the Eureka shareholders obviously end up with a stake in the Aspen business, which, had the transaction gone through, would include Eureka business.
And so when you're creating new shares, that's called dilution, isn't it? Because your individual slice of the pizza gets smaller.
Well, yes, but you need to bear in mind that the pizza itself is getting larger. So it's not necessarily a significant dilution to the existing Aspen shareholders, because they're effectively issuing more shares, but they're also acquiring assets. And if that trade-off is done well, then the dilutionary impact should be minimal.
And in this case, it was done very well by the sounds of things.
Well, that's right. Yes, they've actually come out of it with a nice little profit.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So it's got a pretty impressive revenue growth over the last few years. What's behind that growth?
Yeah, basically they're building their portfolio. They have acquired new properties and they continue to develop new properties. So that's one aspect of it. The other aspect is, of course, that the rents have increased. I mean, that's kind of well known that rents have been going up and they are beneficiaries of that. So it's a combination of both volume and rental increases. And also there's the developmental income. I'm not sure if I mentioned yet, but they make around 32% of their revenue from that development side, where they buy and develop and then sell these house and land packages.
Are there headwinds in that kind of development space? Because I have heard anecdotally how much regulation is making it difficult to develop new properties in new places.
Yes, there is, but I think they've got a good pipeline. They tend to quite often buy on like the fringes of main metro areas. So, for example, they've got a property down in Camden in southwest Sydney. They've got a property about 90 minutes from Adelaide. So, those sort of more regional, but not way out there regional areas, it's a little bit easier in one sense that there's more land available. So, yes, they are subject to the same, regulatory as well as labour and supplies shortages that the whole industry has to deal with. But they do seem to have a good pipeline and they do seem to be able to manage that reasonably well.
Run us through the Stockopedia numbers, Chris, because even value looks good for this one.
Yeah, that's right. So it's very attractive in Stockopedia with an overall stock rank of 95 and value being the lowest, but it's still coming in at 77. And this is a function of the growth that you mentioned in revenue and indeed earnings per share tracking along nicely. Earnings per share are more volatile, but they are still quite solid. The one area that I guess stands out in a negative sense is the balance sheet. It does have a bankruptcy risk in the cautious zone. Looking into that, it was basically came down to a long history of negative retained earnings. I looked back 10 years and the retained earnings were negative for the whole of that period. It's gradually declining, but that will contribute to your bankruptcy risk. And the other was working capital. They've got a negative working capital. Their net gearing is 45%, or using the ratio the company calculates, which is not as conservative, is 26%. But either one of those numbers, they're not alarmingly high, particularly for a property developer. And their net asset value, so when you think of a REIT or a business that has a portfolio of assets, it's important to understand what is the net asset value. That's coming in at $2.18 per share, which is not far off the actual share price, which was $2.32 as at yesterday. So overall, those numbers are pretty attractive. We're getting a good quality score and a very good momentum score on the back of that share price that we've talked about having done really well.
And what about risks? What do you see as risks for this company?
Well, I guess the risks are, there's a number of risks. I mean, we've sort of talked about some of them being the pressures on the property market and, the pressures particularly around getting access to tradespeople and building materials. There's been a lot of inflationary pressure in that space. You would think that there'd be a high risk because of their clientele of people with lower incomes, obviously. But as it turns out, a lot of these people, they're receiving government assistance in terms of their rental payments, and they actually have very low vacancy rates and very low delinquency rates. So you might imagine that would be a risk, and obviously occupancy is a risk for any business like this. They seem to be able to manage that very well and haven't really had problems in that area.
Yeah, it's interesting talking about risk. I've been doing a lot of thinking about risk, and also we were talking with Elio a couple of weeks ago about Resolute Gold, and obviously sovereign risk was a big one with that one, wasn't it?
Yes.
Not that we want to go there in this particular episode. How about the outlook for the company? Do you think they can continue with this impressive growth rate?
Yeah, well, certainly management and indeed the market are quite optimistic about their prospects moving forward. So management are forecasting that their underlying earnings per share will increase by about 10% in this coming year. And they're also anticipating increasing dividends per share by 18%. So as I mentioned, they have a very solid pipeline. So they know pretty much what properties they're going to have coming onto the market in the next 12 months. And they're pretty confident that they can rent those out at a strong yield. So the overall guidance is strong. That guidance doesn't include the profit from the sale of the Eureka shares either, which will just be a nice little bonus. And the market is confirming those expectations with very similar forecasts. So pretty optimistic outlook at this point in time. Probably worth also just pointing out, we haven't touched on it yet, but they own different types of properties. So there's three types that they own. One is retirement villages. The other is more just sort of general residential type properties. And the third is holiday parks. And the holiday parks are more or less your typical caravan park type setup. But what they do a bit more than some other groups is some of the caravan parks are in high tourist areas, and so they're aimed at tourists. But others are in areas where they're aimed more at sort of corporates. So think mining companies. So, they've got some in Western Australia, for example, where there's a lot of transient staff that need temporary accommodation, but it's not temporary as in a day or two, it's months or two, or even longer sometimes. So a lot of those holiday parks actually have quite long-term tenants. So that gives them a revenue profile that's more predictable. But that is a risk. If there is a slowdown in the sort of the tourist side of the market, that will have some impact. But as I said, they're not as leveraged to that as you might initially suspect.
Because that's only a small part of the operation, as you alluded to earlier.
Yeah, it's a smaller part of the operation, and also within that smaller part, there's only a small segment that is actually directly exposed to the tourism market.
And of course, retirement homes, with the baby boomers retiring and aging, that is going to be a huge demographic boost, presumably for a little while.
Yeah, that's right. And I think what was quite interesting is sometimes when we think of retirement homes, we think golf courses, valet parking, or this kind of thing. They're not at that end of the market. They're at the 2-bedroom, 1-bathroom, a basic little home on a basic plot with a small garden, perhaps, maybe a community hall. But it's that end of the market. But there's plenty of people that are in that demographic that need a facility to live in, and they want a nice facility, but they can't afford the 6 bathrooms, et cetera, et cetera.
6 bathrooms. What is it with people in bathrooms these days? When we were growing up, a dunny out the back would be enough.
Yes, the place just next door to me sold with 6 bathrooms, so I've got that number stuck in my head. I can't get over it.
Okay, Chris, thank you very much for your time today. It's great to view at a company that often most of us have never heard about.
Yeah, no problem. It was good to talk with you, Phil. Thanks for having me on the show.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.